let's get straight into it. Paul Ashworth, Cameron Harrison, Chief Investment Officer, joins us on the show today to go through what's been a pretty tumultuous time for markets, and maybe there's a change of broader market dynamics that are underway at the moment. Let's bring him in and get a sense as to what he's looking at. Paul, welcome to the program, and great to go and see you there.
Yeah, good to see you, Dave.
Tell us why you think that the markets may be undergoing a shift away from what we've come used to over recent decades.
Sure. So, the last 12 years post-GFC, particularly for equities and for bond markets, really the last 40 years, have enjoyed a negative correlation between equities and bonds, David. So, as equities have fallen, bonds have come into the rescue. It's given investors, pretty nice, smooth, 10% like returns. And of course, over the last few months, we've seen a sharp reversal of that, and we're starting to see positive correlation. So that's really the challenge for investors going forward, is what that type of relationship's going to look like, and how is it that they might manage that in terms of asset allocation going forward.
Paul, you've got a very useful table here that can go through some of the details to how the environment may go and change and what the implication would be from an investor perspective. We'll bring that up on the screen and let's have a quick chat about what it means for investors.
So, what we've got here, David, is some scenarios that could play themselves out. In terms of where we think central banks here, and in particularly in terms of the Federal Reserve in the US, I think would like to see themselves and would like to see things going forward, would be that that second scenario. That sees the supply side pressures start to moderate. It sees continued gradual increases in their cash rates, and fundamentally it brings inflation to a controlled position, and that could get us back to that position of that negative correlation, which, if you like, is been that Goldilocks type environment over the last 15 or so years. The key thing from our perspective is we've operated in a period where central banks have kind of operated not to rules. They've been quite discretionary in terms of how they've set their policies. They've acted fairly contrary to, let's say, something like the Taylor's rule. And certainly we saw at Jackson Hole the end of last week in terms of Powell's comments. We're starting to see the fact that we need to operate to some rules here, and the market needs to understand that's going to be the case. We do think that the Federal Reserve will keep to this newfound sense of operating to rules, and we think that that second scenario does have a reasonable probability of transpiring, and I think that's useful for investors because it helps investors look past what's obviously occurring. We can look at today on the markets. It allows investors to look past the next few months, particularly in terms of their asset allocation strategies, and more to what that ought to look like and how that'll behave, let's say, in 12 to 15 months' time, and I think it looks better.
So a higher volatility environment moving forward, to go and generate alpha in such an environment, where are the kind of asset classes that you're looking to at this point in time?
Well, what we're looking for, particularly in terms of our equity strategy, is high quality industrial businesses. We see that those businesses, David, that certainly the pressures in terms of input prices are causing issues for those managements. But those businesses that are able to take the opportunity in terms of efficiency, in terms of productivity, but very importantly do have the ability to get through price increases now. So it's that combination of being able to get those price increases in, being able to drive their cost base down, improve their productivity. Yes, it makes for tough earnings over the course of the next 9 to 12 months, but it sees them in that environment that we're talking about, where we get more normalised conditions in terms of inflation in the economic environment. It's those businesses that can really punch through. So they're really good quality industrial cyclicals that do have some pricing power.
Really quick one to finish off. This high volatility environment, with sticking with rules with central banks, this is a good thing for financial markets, the longevity of the health of financial markets, that we now have this kind of environment?
Well, if we can stick to it, David, that's the danger is always in the assumption. We've heard obviously the other comments out of Jackson Hole last week. Time will tell whether they can actually keep that going, and keep the wheels on the road in terms of keeping to some rules. If they can, and I think they will, particularly in the US, David, they have to. I think they're less concerned now in terms of financial market outcomes. We've seen an increase in markets over the last month or so. That's achieved the opposite of what the Federal Reserve wanted. So I think they have broken from the market put to now actually being the market call. And I think that breaking of relationship, yes, it provides volatility in the short run, but it'll certainly make it a whole lot better in the medium to long run.